Michael Burry's in the headlines because people say he's repositioning his portfolio for a big market crash. I think that this is a misinterpretation of his position. The truth is more nuanced, but also more interesting. And in this video, I look at exactly what he's doing and the reasons which I think underlie his choices. This video is sponsored by Trading 212, which is a UK commission-free investment platform. So let's look at Michael Burry's positions and the reasons behind them in a bit more detail. So this is the kind of headline which I'm talking about, and I think these are quite misleading. For example, it says that Michael Burry has bet more than $1.6 billion on a Wall Street crash. As we'll see, that's just not true. But who is Michael Burry and why do we care what he says? Well, he's very wealthy because of his own investments, but also presumably money he made on Wall Street. And in 2000, he set up his own fund to manage his own money. This is called Scion Capital. But in fact, 2008 wasn't his only good call. He made another one with the dot-com bubble where stock prices fell. He betted that markets would fall and he made lots of money in that sell-off as well. But as we'll see, his track record isn't that great if you just go by what he says. And another reason why people pay a lot of attention to Michael Burry is that he was the star of the film The Big Short. And here you can see he's being played by Christian Bale. How do we know what he's buying and selling? Well, because he runs so much money in Scion Capital, he has to file things with the Security and Exchange Commission, something called a 13F. Now, these are imperfect records because they're only filed every quarter. They're backward looking, so they have to be filed within 45 days of the end of the calendar quarter, and they don't show everything. They only show US listed stocks, American depository receipts, ETFs, and some derivatives. So if there are non-US listings, cash positions, or just straight short positions, we're not going to see those. So in case you were wondering what short means, let's just quickly delve into how he makes money when stock markets fall. So if we go to the first quarter of 2023, say May the 17th, and let's say that the NASDAQ tracker, QQQ, is trading at about $330. If you think the price of that index is going to go up, well, you could just buy the ETF for $331. But how can you make money from it if you think it's going to go down? Well, in that case, you can do something called buying a put option. That gives you the right to sell QQQ at a price that you choose. Now, of course, if you choose to sell it at a high price, well, you have to pay a lot for that. Usually people will choose this so-called strike price to be below the current market price. Let's say we choose something 20% below. So we buy a put option that gives us the right to sell at $265. That means that if the price of the NASDAQ falls below that, say to $250, then we can buy QQQ in the market at $250. We have the right to sell that to somebody for $265 and we've made $15 profit. So you make money with these put options one for one if it goes below the strike price. So this allowed Michael Burry to make lots of money in these falling markets in 2000 and 2008 by having these put options. So these come back into the story in just a moment. So now let's look at his big short. If we plot the total amount outstanding in his portfolio, in other words, we just add up the value of all his positions quarter by quarter, you can see that gradually it started to increase from Q1 of 2022, and it was a pure stock portfolio. There weren't any derivatives visible. But then in Q2 of 2023, we got this massive increase in the value of the portfolio, dominated by two huge positions. If we break it down by sector and also type of investment, you can see how those two positions dominate. The put options in his portfolio are shown here in green. There's the QQQ put option, and there's also a put option on the S&P 500 tracker, SPY. This is what the filing looks like itself on the SEC's website, and you can see those two put options highlighted here in red. Now, the reason why those positions look absolutely massive is that each of those put options gives you a right to sell 100 shares. So if you have 20,000 put options, as Michael Burry does, then that looks like 2 million shares. 2 million times the value of QQQ or SPY gives you these massive numbers that we saw in those headlines, which add up to 1.6 billion. But how much are the options actually worth? Well, the total value of the stocks in the portfolio, ignoring the options, is just over $100 million. And the notional of the derivatives is 1.6 billion, but that's not what he paid. Because of the huge amount of leverage in options, you pay a small amount today to control a very large position in the underlying asset. Given the 60 times plus leverage, which he likely had, this means that he probably paid just tens of millions. One estimate is that he paid about $30 million for the overall positions. Now, the precise numbers are completely unknowable because the 13F doesn't have the strike of the options or the expiry date of the options. The longer the expiry, the greater the price of the options, and the closer the put option strike to the current market value, the greater the price you'll pay up front. But using reasonable assumptions of 1 year expiries and 20% downside protection, this is how we came up with about $30 million. But this is much less than the 1.6 billion, which is quoted in many headlines. Now, many of the stocks which we're discussing today trade on US exchanges and are not available on some UK platforms. But Trading 212, which is kindly sponsoring today's video, allows you to trade those stocks directly. Now, it's a platform I've been using for some time here in the UK. I like it because it's very low fee, but it's also very innovative. So let's say that you want access to those US stocks. If you've got a Trading 212 real money account, then you can trade many US stocks, such as this Berkshire Hathaway Class B share. So if you want a slice of Warren Buffett's portfolio management, you can trade that using Trading 212. Now, one of the things you can do is convert your money from sterling into another currency like euros or dollars and keep it in your account in that currency. This means you can separate the decision about when you convert your money and when you buy stocks. So by converting it when there's a favorable exchange rate and then trading around in that currency without having to convert it back, you could potentially increase your returns. So just to demonstrate this, I've put £10 into my Trading 212 real money account, and if I wanted to convert that into US dollars, I could do that very easily. You can see the fee here would be about 2 cents for the conversion. Then if I chose to sell my US shares, I wouldn't have to convert it back into pounds straight away. I could go off and buy other US shares in US dollars. So this way you can save on your FX fee if you are someone who does trade on other exchanges. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim a stock worth up to £100. In order to claim that, you need to create a new Trading 212 account. You have to fund it with at least £1 and verify the account, and then use the promo code, which is my first name, RAMIN. To really understand the thinking behind Michael Burry's trades, I think it's helpful to look at the sector composition of his portfolio. Here that is when we've stripped out those two option positions, just looking at the single stocks which he holds. Now, the kind of dark blue colour here is the consumer discretionary sector, and that certainly dominates his portfolio at the moment. Now, is this a bearish position? Far from it. Consumer discretionary, remember, is the kind of stuff that you don't really need. It's luxury goods, cars, voluntary things which you can spend your money on. Now, if US consumers are coming out of a recession and have money to spend, this sector would benefit. So clearly Michael Burry is pretty bullish on the US economy right now, despite all of the stuff he says in his Twitter account. Expedia Group is currently the biggest holding which he has, and frankly, if the US goes into a recession, it's unlikely many people will be booking holidays. So the largest sector allocation is for consumer discretionary. That makes up about half of his portfolio. And then we've got the energy position, which is held for a while now, which we'll dig into later, but also some defensive stocks in the form of healthcare. We've also got some industrials and we've got some telecom stocks. Then we've got a new position for Q2, which is in Japanese stocks. So let's dig into the consumer discretionary sector holdings. And you can see those are faring pretty well. They're not soaring upwards like the Magnificent 8 stocks, such as Nvidia, but they're steadily increasing. including what was then his biggest holding, which was Expedia. Not all of his stocks are doing well. For example, Curate is doing pretty badly and iHeartMedia is too. But still, he's chosen some pretty good stocks here in terms of performance. Now, it's kind of interesting that he's taken a long position on Japan and he's done so via exchange-traded funds. Now, I made a whole video about why Japan is currently popular. Maybe he watched that video. This is one I made for Trading 212 on their channel on YouTube. And in fact, he didn't just buy one ETF, he bought 4 of them. 2 of them give broad exposure to Japan, and 2 of them are kind of interesting. He's gone for MSCI Japan Value, so these are undervalued stocks in Japan, and he's also gone for small cap Japan exposure. What's interesting about Japan's market is that many of its largest stocks are exporters. So these really feed on global growth and particularly growth in the countries to which Japan exports, such as China and the US. But if you go for Japan's small caps, that's much more of a domestic market. So that's a play on Japan's domestic economy, which presumably he thinks is going to perform well. That hasn't panned out yet. That's the most poorly performing ETF he chose, but it's an interesting position nonetheless. His Q1 filing showed that he had a very large position in China, which was focused in just 2 stocks, JD.com and Alibaba Group. That made up 1/5 of his portfolio. However, his Q2 filing shows neither of those 2 stocks. They have been pretty choppy. If you look at the share price, you can see that it's been very much up and down. We don't know the precise timing of his trades, but what we do know is that in Q4, Alibaba, for example, his position was about 4.4 million. And by the time we got to Q1, which is the previous quarter, that had more than doubled, as had JD.com. It went from 4.2 million up to just under $11 million. So presumably, he made a pretty chunky profit on those 2 recovery plays in China. An ongoing theme in his portfolio is for energy. And it's surprising he's stuck with that, given the crash in energy prices since middle of 2022, for example. Presumably that's because he thinks there's going to be a resurgence in energy prices, and we have seen them bump up recently. And if we look at the stock prices of his positions, you can see that almost all of them are rising pretty sharply at the moment. So that was a pretty good call. Now there's a big but that you have to consider when looking at his portfolio, which is his track record. And there's a big difference between what Michael Burry says and what Michael Burry does. So if we look at his terrible pronouncements on Twitter, and remember his Twitter handle is Cassandra, which in mythology was someone who was given the gift of prophecy but was also doomed never to be believed, the accuracy since 2015 has been pretty appalling. So in 2015 he said a crash was coming in a few months. Well, it didn't really materialize. Then in 2017, he said there'd be a global financial meltdown. That didn't happen either. In 2019, he said there was a bubble in index ETFs, which he's just been buying in Japan, remember. In 2020, he revealed his massive bearish bets in markets. Remember what happened after that, after the big crash? Was a huge rally. Then in 2021, he said there's a market bubble crash coming. In 2023, there was a massive recession coming, so you should sell. And we've just seen his bearish positions, which aren't really very bearish at all, in his Q2 filing. So I think it would be unfortunate if you'd have followed all of his terrible warnings, because you'd have missed out on a huge rally in the United States over the last decade. Maybe he should think about moving to China, because there at least some of his predictions would have been more accurate. For example, the big crash in 2021, markets in China were down around 42% for that crash. So I think what you should try and do is separate what Michael Burry says from what Michael Burry does. Those are 2 very different things. He's come up with these very bearish pronouncements on Twitter, or X as it's now called, but in fact his portfolio is pretty bullish if you look at the sector composition, and I think also the put options that he's got in his portfolio are really just going to benefit if the huge narrative around AI in the United States collapses. That's because the QQQ, the Nasdaq, is very much driven by those mega cap 8 tech stocks whose share prices have been pushed sky high by the AI narrative. Now, if their profits fail to deliver on that promise, then it's likely those stocks will snap back, and who knows, it could push his put options into the money. So really what he has is a long short position where he's long those value stocks which he's chosen very carefully, and he's short the broad market. So that's his real position. And I think it pays to delve into it in more detail than you get from just headlines. More broadly though, I'd say don't try and copy other people. It doesn't usually make sense. Use their portfolio to inspire what you do in your portfolio, but what a billionaire does with his portfolio is almost certainly not relevant to what you do in yours. For most people, it's best simply to buy an index fund, buy it, hold it for a long period of time, and just forget about it. Don't try and be Michael Burry or Warren Buffett. Now, don't forget our offer from Trading 212. If you want access to a stock worth up to £100, you can do that by going to Trading 212, open a new account, fund it, verify it, and use my name as a promo code RAMIN. And as always, thank you for listening.